So the next topic we are taking up today is organizational forms. So there are various organizations which are existing. We have sole trading, we have partnership form of organization, we have company form of organization. In that also we can have lot many subcategories. Corporate issuer features. That means who are corporate issuers? The one who issues certain securities and raise funds, and the ownership. Who is the owner of who, like to whom that company belongs. So features of corporate issuers. Compare the organizational forms of businesses. Let's see here. Organizational forms refer to how businesses are set up from a legal and organizational point of view. So, like sole proprietorship is one which has single owner. It requires less capital, less scrutiny, less paperwork. Even registration is not required in certain cases, but in some countries they want the sole traders to be registered. The sole trader need not disclose any information to anyone because the sole trader is the one who is the only owner of the company, and the sole trader is only the one who can preserve the information with himself, because no one or the sole trading firm doesn't have any kind of outside investor. It's understood fact. So henceforth, it doesn't matter if they're in profits or losses or whatever. It only matters for them. It doesn't matter for the society as a whole, or government as a whole. Okay. But when it comes to partnership, more than more than one person. In the sense I'm speaking about two, minimum two and maximum. Certain laws have certain kind of maximum numbers. Somewhere it is 50, somewhere it is it can be more than that. So, like when people they come together, join hands together, and they do businesses collectively with expertise and resources invested either equally or in some other proportion or ratio. It's a partnership firm. They are running, right? So they kind of share the profits and losses, whatever, amongst themselves, either equally or in the proportion of the capitals what they've invested, depends upon what they have agreed amongst themselves. And there's a partnership act which guards the partnership firm and the rights of the partners. And agreement is very important, of course. It can be written on oral. It doesn't matter. It is somewhat bigger than the sole trading firm, but somewhat lesser than the company form of organization, because more capital than sole trading, less capital than company form of organization. There can be limited partnership, unlimited partnership. Limited partnership is like having the liability, limited liability, okay, only to the extent of the investment what the partner has done into the partnership firm. They need not sell their personal property or personal assets to settle the debts or obligation. In case of limited liability partnership, that is LLP. In US, LLP are only allowed for providers of professional services such as law, accounting, like Deloitte, KPMG, and whatever the audit firms you see, they are LLPs. Okay, so on, and there are restrictions on number of partners and amount of equity investment. So how many partners can be? There's some restriction, it seems. So we don't know the law completely what is in US, because this course is something which is universal course. So laws may differ in different countries, right? And in case of unlimited partnership, the liability is unlimited. That means they have to sell their personal assets to settle. And then comes the the corporation or limited company. There can be private company, public company. Private company is one in which private individuals put their money collectively. And in partnership also, they need not disclose any information to anyone, because the partners are the ones who are responsible if the partnership firm is going to losses. Only the thing is, in case of limited partnership, liability is limited. In case of unlimited partnership, they have to settle the obligations. And in case of company form of organization, private company, even they need not disclose it to the general public. But yeah, as they get registered themselves with the register of companies, okay, so they have to disclose certain information to the registrar of companies. Fine. And public company is the one public company is one where the people's money is involved. Fine. There can be some private individuals and some and general public, some shareholding with private individuals and some shareholding with the public. And in public company, since lot of people have invested their money in public company, and lot of like many people are owners in that company. See, company can be run in two ways, either through equity finance or through debt finance. Now, in either of the ways, some equity and some or combination of debt and equity, fine. It can be all equity, all debt, or combination, fine. And like when in case of public companies, since the investment is very large and mammoth and huge, we expect general public to involve general public to be a part of the company. And since when people are involved, the government comes into action and they have to protect the rights of the shareholders, and the shareholders shouldn't be exploited in any ways. Henceforth, they set certain regulations, certain compliances, which every company should follow. Like the company's law should be followed very ardently and very, I mean to say very rigorously, so that no, there shouldn't be any kind of issues with the compliances. And the board of directors are the ones who have a fiduciary relationship with the shareholders. They are the agents of the shareholders who are running the company on behalf of shareholders for their best interest. Fine. So I have explained about the public corporation, about the public private company. When some friends and relatives start a company, it's a private company. When public is involved along with the private people, along with some certain individuals, then it is public corporation or public company. There's public sector company also where government and public are involved, right? Like Indian Railways. And where people are involved, the scrutiny comes into picture. They have lot of paperwork, lot of documents, lot of disclosures, lot of restrictions on the company. Fine. And a public corporation is one that has shares that are sold to public and trade in an organized market like stock exchange. First time, whatever the shares are issued are as per the initial public offering IPO, and once the shares are sold, those shares can exchange many hands in the secondary market, that is through stock exchanges. Now, private limited company is similar to public company, but it has limited number of shareholders and restrictions on transfer of shares. Of course, private members cannot transfer their shares to general public. In public company, they can the shares can change many hands and can be sold to any XYZ. Depending on the country, a corporation's profits may be subject to double taxation. If government taxes companies on their earnings and also taxes on dividends, then it is a big issue. So in many countries, what they do is they charge companies, they charge taxes on companies on the profits, and whatever the dividend income the shareholders receive, again, that is also taxed. So this is also something to be considered, right? So they say, right, many times, no, you invest in certain investment options which give you tax benefits, because if you invest in direct equity, then it is taxable. So you have to understand that. Describe key features of corporate issuers. A corporation's legal identity is separate from that of its owners. Of course, because company is an artificial person by law. They are the ones which are different from their owners. Fine, it's a legal entity, and they have to get themselves incorporated or registered, and they are a separate legal entity. And the corporation has many rights and responsibilities of an individual, such as right to hire employees, enter into contracts, borrow and lend money, and so on. They will do on themselves because they have that right, those rights with them embedded. Okay. Corporation issue shares to. Sorry.
I wanted to know if what is the meaning of corporate issuers?
The ones who are issuing the shares to people or securities to the
Yes.
people to raise the funds, the companies.
Oh,
You don't
yes.
see sole traders and partnership firms to do that, right? Only the companies do
Yes.
that. Yeah.
Okay.
So a corporation issues shares to owners, shareholders, and to raise the funds, and they get voting rights with one share automatically, whatever they buy. And these shares can be sold to anyone else. And the board of directors are the ones who are responsible and answerable to shareholders. They have to make the company profitable, and they have made promises to shareholders that they'll maximize their wealth. So they have to also give dividends to shareholders, make sure that they give dividends, because that keeps the shareholders motivated. The disadvantage of double taxation is, of course, there. Of corporate income is less for investors in companies that pay out a small fraction of their profits in dividends and reinvest the remaining, as illustrated in the following example. So, what generally the companies do is, instead to save the investors from any kind of double taxation, they give some amount as dividends, and they retain a lot of amount with them, and that they reinvest. So the investment value would grow in the future, right? So there is a question here, double taxation of dividends. So this is a disadvantage, right? Twice they are taxed. The company is taxed for profits, and dividends are taxed, which is received by the shareholders, right? So with reinvestment, what is happening? They are not getting cash in their hands, but the value is growing every time, right? And small amount of dividends is given, so less taxes they pay. Now, double taxation of dividends. ABC Corporation has a pre-tax earning of 10 million and a corporate tax of 25%. So this is before taxes. Okay. Just a second. Just a second. Of $10 million and a corporate tax rate of 25%. This is the tax rate which they have to pay on profits. Shareholders are taxed 20% on their dividend income. Calculate the effective tax rate. If, see, effective tax rate is different than the actual tax you are paying. That is effective tax rate. The formula is total tax what we are paying divided by earning before tax. This is the formula. That means what was the earning before you paid the taxes and what taxes you paid out of that earning. So let's say if I paid 10 rupees as taxes and my earning before paying any tax was 100, so 10% is my effective tax rate. Okay. So they're asking you to calculate effective tax rate if 100%, like total amount of the profits was paid out as dividends. So double taxation issue is there, right? And only 40% of the profits are paid out as dividends. Then what? So EBT is given here. Pre-tax earnings. Taxes are, deducted. This is after tax income. Dividends are paid. 100% of the profit is paid as dividends. Isn't it so? Here only 40% are paid. And tax on dividends, what you have to pay to the government is 15 lakhs or 1.5 million. And here only 0.6 million as taxes. So total taxes what you paid is this corporate tax and this tax on dividends. That is $4 million. Here the total taxes paid is $3.1 million, very less. So the effective tax rate is 31%, which is less here. So like definitely this is a more viable and more better option, right? Than this, yes or no?
Yes, sir.
That's what. So it is better to retain some money and then give the shareholders some amount as dividends, so that they pay 9% less taxes in this case. Now compare publicly and privately owned corporate issuers. See, most of the public companies are listed companies. They have to get themselves listed in the stock exchange because when people are involved, when public invest their money, like listed companies have a better goodwill, a proper, because they have to disclose a lot of things. That is the requirement for listing a company, or listing requirements are very stringent as compared to non-listed companies. So risk would be less in listed companies than unlisted companies, right? And like shareholders in a company can be individuals, other corporations, non-profit, or government. Okay. So in any of the companies, the shareholders can be either an individual, either a company, either a non-profit organization, or government. Shares that are actively traded are called companies free float. And this should not be held by the insiders. That means companies' employees, as per the ESOP, employee stock option plan, or strategic investors or sponsors. Free float, that means which is held by the public themselves, is typically expressed as a percentage of total outstanding shares. And this is relevant. This is what it matters. Public companies are subject to a lot of compliances. As I told you right now, these are all like discussed points, and they have to file quarterly and annual financial reports with regulatory bodies. There are certain forms also they have to fill up, like 10Q, that is quarterly form. some company like US companies or Canadian or outside companies which are registered in US, they have to file the annual, they have to submit the annual financial reports. They have to disclose everything in the disclosures, whatever the changes they have done in the accounting policy or any kind of major changes which have happened, they have to disclose and give the reasons for that. Shares can be sold to investors or can be done as a private placement even. Only fewer investors in that case, like very big companies like LIC, Life Insurance Corporation, GIC, General Insurance Corporation, UTI, Unit Trust of India in India. In that way, there can be some institutional investors or very big investors or accredited investors who can invest, or very high net worth individuals or some private equity funds like Blackstone or someone can take lot of, or very big, or a investment bank can also outright buy this IPO and then sell the shares to people, underwrite the entire shares and sell to people. It can also happen. So these are called institutional investors, and public companies can become private companies can also become public company or go public in three ways. If they are going for an IPO, issuing the shares to general public, if they are listing themselves in the stock exchange, and also a special purpose acquisition company is a corporate structure set up to acquire a private company in the future. So some SPAC is going to acquire a private company, and this SPAC raises capital through an IPO to acquire this company, or they raise funds to acquire this company. Okay. Okay. And what they do is they raise funds through an IPO. That means a company is formed here, special purpose acquisition company is formed to acquire a private company in the future. And what they do, they raise funds through or they raise capital through an IPO, and they put these funds into a trust. And because the reason is very clear, this company has been formed only for the purpose of acquiring a company. So hence they put their money in a trust, and that it must use to make an acquisition within a specified time. For that purpose only it is formed, not other than any, not for any other purpose than this. So acquired company does not have to be identified at the time of IPO, because it is kept, they need not disclose which company they want to acquire. For this reason, SPACs are also known as blank check companies. And sometimes, did you understand that, Bhargav?
Yes, sir.
Yeah. And sometimes there can be a benefit to taking an underperforming public company private to restructure it and unlock its potential value. They want to acquire some SIC units. Okay. And in such a case, an acquirer purchases all of the outstanding shares of public company, and the company is delisted from the exchange. The benefits of
So,
going private. Sorry.
so can you give an example of SPAC?
SPAC.
Real life example that had it ever happened with any company?
It happened. See, real life examples can be many. So if you want, just a second, I have to just search and tell you. 2 minutes.
Yes.
Yeah, 2 minutes. Huh? Just actually, we like the meaning itself is okay, because there can, any company can do this, and in the previous past, because see, many companies do this.
No, I'm
So
asking about
as
any example. So it can be made up also.
yeah,
I
yeah,
don't want the actual company.
don't worry, giving. SPAC. Okay, real life example for special purpose. 2 minutes. So, see, you may not be knowing them. That's what I'm saying. You may not be knowing many of them, because
Yes,
these are
sir.
only for some particular purpose, right?
Right, sir.
So most popular businesses on the special purpose acquisition company list are Pali, Hapitia, Social Capital, Hedo, Sophia Holdings. See, even I don't know these companies, really speaking. Most famous SPAC is Churchill Capital Corporation 4. So,
Okay, sir.
yeah, Churchill, 2 minutes, Churchill Capital. That's the reason why we don't dig that much into this, because these are useless ones, only for one purpose. Once the companies are acquired, finished. These companies won't exist. Corporation 4. And this is also called a CC4. And
They raise
this,
capital, they start a fund.
sorry.
So what happens in this is they raise money from the public and they start a fund. They create a trust fund.
They raise money from public and they kind of buy a company. That's it.
Oh, right. Okay, I understand.
Yeah, I'm giving a small example. So as real life example I'm giving. So this SPAC has been the most successful of all time, raising $2.07 billion in its IPO and merging with EV maker Lucid Motors in 2021. The deal valued Lucid at $24 billion, making it one of the largest SPAC mergers to date. So they raise funds and they merge also. Okay. Hello.
Yes, sir, I'm listening.
And some of the some companies, they don't make this. Let me be very clear. Like Google acquired Google's $50 million acquisition of Android in 2005. Android was a separate company. Google acquired them, but they did not go for SPAC. Okay. And let me tell you one thing. These SPACs, okay, are SPACs allowed in India? We have SP special purpose vehicles. The regulatory environment in India does not have provisions specifically tailored for SPACs. Okay. But they make some financial vehicles and they do that. Understood?
Yes, sir.
And one more thing. Hmm, one more example I will tell you. See, generally companies can directly go into the market and raise funds through an IPO. But why are they forming a SPACs? Here, the money taken by the public is put into a trust. So when it is put into a trust, then the funds are entrusted. That means people will have more confidence now. Are you understanding? See, if I take your money and I form a trust and dive and put your money in that trust means I'm taking it's a lot of guarantee, right? A promissory notes I have to issue and all. I have to if I entrust your money into a trust, then it's legally very safe, right? Because now the trust is the one who under whom or which is the trustee of your money. And next you can get your money from them. That means the money will not be utilized for any other purpose rather than acquisition. Are you understanding?
Yes, sir.
That's the reason why it is very good to form an SPAC and raise the funds rather than directly going for an IPO. If your company is very well-known company and people trust your company a lot, then that's okay. Then that's okay. Okay. So
Yes, sir.
like likes of Google and App, no one has any issue with such kind of big companies. So I'm sending you a link here. So
Yes,
in
sir.
2019 itself, SPAC IPOs raised $13.6 billion. So you understood like this, because these are only meant for just raising funds and buying companies. That's it, or merging or acquiring. Okay. And less of scams also happen in this case. And real world example, as you're asking, one example I'll give you. You know Richard Branson? Hello.
Yes, sir.
Do you know Richard
Hello.
Branson? What
Yes, sir.
man? The Vijay Mallya of UK. But to some extent, I will not put that name to him. I'll put Vijay Mallya copied Richard Branson in every case. So today you
Okay,
do
sir.
some research on Richard Branson, Virgin Atlantic. Actually, Atlantic
Yes.
Galactic, actually, it's a high profile. So it's, Virgin Atlantic, Virgin Mobiles came to India, right? Very big.
Mm.
He's a billionaire. He has some private islands. It is a big time businessman. So Virgin Group. So Richard Branson, Virgin Galactic was a high profile deal involving special purpose acquisition companies. Venture capitalist. So venture capitalists are the ones who are very rich people or rich companies or private funds or equity funds. Chamath Palihapitiya. So Chamath Palihapitiya is a venture capitalist who has formed an SPAC. Okay. Social Capital Hedo Sophia Holdings bought 49% stake in Virgin Atlantic Galactic, sorry, for $800 million before listing the company in 2019. These are some of the real-time examples. You may not have heard also, you may have not known also, because not from India. In India, these kind of things have not happened because the regulatory bodies in India are against all this, or they haven't gone to this kind of extent for any kind of acquisition. But yeah, in UK, US it has happened, and I'm sending the link to you. Okay.
Yes, sir.
Yeah, did you understand now that to
Yes.
acquire a company, some SPAC is formed, and real world examples I've shared with you right now. And one more, yeah, some kind of examples are there, but I'm saying you have not heard about those companies as well, so you may find it somewhat out of the box. So in 2020, Bill Ackman, founder of Perishing Square Capital Management, sponsored his own and the largest ever SPAC. Perishing Square Tontine Holdings, which raised $4 billion in its offering on July 22, 2020. In August 2021, Ackman planned to liquidate the SPAC, but as of 2020, the SPAC had not been liquidated, with efforts still underway to find a deal. So they raised a lot of funds to buy some companies or to buy their own stakes also. Okay. But they are not able to sell liquidate that SPAC. The deal is underway. This is the news of 2022. Today we are in 2024. So must have been liquidated, but in Investopedia website that detail had not been given. So I think they have to update their website for this. There's a Harvard Business Review report also. I will send a SPAC report to you. So, these SPACs are garnering a lot of attention lately in corporate boardrooms, on Wall Street, and in the media, and for good reason. Although SPACs, which offer an alternative to traditional IPOs, have been around in various forms for decades. I already told you, you can raise your funds through IPOs or SPAC, but SPAC is more trusted, right? So people go for that. That's it. If you open a special company for that purpose only, see, if I raise IPO, what will happen, Bhargav? Through an IPO, there can be a chance that I can divert those funds for some other purpose, right? Satyam did, right? Satyam raised the funds for software company, and they started a new company, Mitas, and they bought a lot of lands near Kompally, North Hyderabad and all, and then invested a lot of money there. And one fine day, what they said is, no, we will get all the money to you, to the shareholders, but shareholders' trust has been what? Exploited. Why? The money which was taken for a certain purpose is diverted and utilized for some other purpose. Who will trust you now? So if SPACs are open, they will kind of transfer all the funds in that, and that is protected now. Understood? Because it's very regulated one now. Got it?
Okay, so I understand.
So yeah, the benefits of going private. Yeah, many companies go private, right? Because now what they do is they don't want that much of scrutiny. They want lower regulatory burden and also cost savings. Because public companies are the ones, lot of scrutiny, lot of paperwork, lot of disclosures, and lot of they have to, for all this they have to spend a lot of money as a cost. So some companies go private by buying their own shares from the market, from the public, and they go private. Okay. So this is what is the end of the chapter. We have finished three chapters, I think, almost from corporate issuers. I'll be sending the PDF of this as well to you.
Okay.
Tomorrow's topic will be tomorrow we'll do corporate governance. Okay. This one will be 3. Yeah. 4th one is done. Then we'll go for this 2. Okay. Right.
Okay.
Thank you, Bhargav. Yeah.
Thank you, sir.
Thank you, dear. Bye.